Very good afternoon, dear students. I, Dr. Jamaludin Nasir Ansari, working as assistant professor in the Department of Commerce, Interior University, Lucknow. Today, we are planned to discuss with you on the topic financial statement analysis. As I told you in my previous lecture, that financial statement analysis, why it is an important concept, and basically what financial statement analysis stands so for. So we were once we're talking about the concept of the financial statement analysis. This financial statement is prepared by the financial accountant. Means books of account is ready. Now its analysis, its management of accounting information is required for the decision making purposes. So here we will talk about the financial statement analysis. Means what are the tools and techniques by through which we can take the financial statement analysis. So when we're talking about the financial statement analysis, it means a thorough examination of books of accounts, means for the purpose of decision making purposes, for taking appropriate decision making. So here in this context, financial statement analysis, in this lecture we will cover the introduction to financial statement, income statement, cash flow statement. We will talk that what about the cash inflow and what about the cash outflow, statement of shareholder equity. We will also talk about the analysis financial ratios. We will also going to discuss, we are also going to talk about the interpretation of the financial data, budgeting and forecasting, compliance and regulation. Later on we will also understand the balance sheet, and also we will analyze the income statement, evaluating the statement of cash flows. Then later on, we will talk about the what are the various tools and techniques available for the purpose of financial statement analysis. And out of these, the most important analysis techniques available is the ratio analysis. Under the ratio analysis, there are number of liquidity first, like liquidity, solvency, and profitability trends. Analysis and benchmark, we will also discuss identifying red flags and warning signals, forecasting and projection on the basis of these past information, on the basis of this present information, we will forecast for the futures. Integrating financial and non-financial data, and last we will talk about the concluding remarks of this entire lecture. So this is about the broad outline on which we have planned to discuss with you all the various concepts of accounting, financial statement analysis. Now we are starting with the first point, that financial statement means a comprehensive guide. So as I told you, the financial statement are the backbone of any enterprise, not only for the business, but every banking companies, business enterprises, non-business enterprises, books of account is that serve as the backbone for financial statement analysis. They provide a clear and concise picture of a company's financial health, performance, and position. Only and only the single document which enables all kinds of financial statement, financial affair of the company. The financial statement will enable, will answer all kinds of unanswered, or answered questions. Means why it is prepared, when it is prepared, and what are the significance of this financial statement. Understanding financial statement is a critical and crucial for informed decision. Whether you are investor, business owner, or financial professional, whosoever is stakeholder of the company, and everyone interested to know the financial health, financial position, financial result of the company. The financial statement analysis will answer all kinds of questions, that why it is prepared. And from the investor perspective, financial statement going to tell you that what about the investment, what about the cost of capital, in return on investment, risk associated with such kinds of investment. Tax authority always interested to know the financial position, the financial result of the enterprises. Talk about these Reliance company, and talk about these Tata and Tata and another. So their financial position, their financial soundness, financial health are very sound. So they are paying more taxes compared to those who are having low financial soundness. So under this lecture, we will guide you through the fundamental concept of financial statement and their key component, and how effectively analyzing them. Under these lecture, on this discussion, we will talk each and everything about the financial statement, means what are the various tools and techniques available for the decision making purposes. So, financial statement, you can say, bro, basically is the what statement of finance, means books of accounts. So, under these, the first one is the balance sheet, which is the most important part of the financial statement of any business organization, which provide a very comprehensive frame, which framework, background of any company. Finance, they are providing a very very fundamental document to check the financial performance, financial health of the company. So balance sheet is what basically is a snapshot of company's financial position at a specific point in time. It reflects the company's assets, liabilities, and equity. Assets are resources a company owns, such as cash, inventory, equipment, liabilities, or the obligations a company owns to others, such as loans and account payable. Equity represents the ownership interest in the company. So when we're talking about the assets, so current assets, these are the assets that expected to be converted into cash within a year. For example, cash, accounts, receivable and inventory. Non-current assets, these are the assets that are expected to be used for more than a year. For example, land and building, plant and machinery and other equipment. Similarly, when we talk about the liabilities, the current liabilities, these are the obligations that are due within a year. For example, account payable, salaries payable, other short-term loans. While on the other hand, we have also certain non-current liabilities. For example, these are the obligations that are due beyond a year, such as long-term debts and deferred revenue. And most important part of this balance sheet is what equity. This represents ownership, interest in the company, including retained earning and common stock. It reflects the value of the company that belongs to the shareholder. Means if you are the owner of the company, anyone who have holding these equity, they are supposed that they are the real owner of the company. So when we're talking about the financial statement analysis, we means a statement which reflects the true pictures, the true position of books of accounts, of the true picture of the of the affairs of the business. So the first document under these financial statement is the balance sheet. Similarly, other most important document where entire decision are based is the income statement. After the balance sheet, once balance sheet is ready, the then income statement is also taken for the purpose of decision making, right? And every stakeholder interested to know the financial result of the company and financial position of the company. So when we're talking about the income statement also known as the profit and loss statement summarizes the company's financial performance over a period of time, usually a quarter or a year. It reports the company's revenue, expenses, and net income. Revenue is the total amount of money earned from the sale of goods or services. Similarly, expenses are the cost incurred to generate that revenue. In order to generate the revenue, number of expenses incurred day by day. And the business, when we're talking about the business platform, so number of expenses incurring directly, indirect. Some expenses are what fixed and variables for the purpose of generating the revenue. So these have also a importance to record in the books of account for the purpose of to checking the exact the profit of the position of the company for economical result as well as economical position. So income statement, the most important thing under the income statement we are going to mention is the revenue. The income start with revenue, the amount earned from the sale of goods or services. It is the top line of the income statement. Second, cost of goods sold, COGS, which is also one of the most important part. The cost of goods sold represent the direct cost associated with the producing the goods or services sold. It is subtracted from the revenue to calculate gross profit. Cost of goods sold, revenue less gross profit, you will get cost of goods sold. The third most important aspect of income statement is the operating expenses. Means operating expenses are the cost incurred in running businesses such as salaries, rent, taxes, utilities, and marketing expenses. These all are the expenses which are incurred for the purpose of operation of the business. And day by day, these expenses are incurred. So salaries, rent, utilities, and various kinds of overhead expenses all are associated with this business, right? Are recorded in the debit side of the income statement, trading profit loss account. Third statement, which is known as the net income, means net income is the word bottom line of the income statement. It represents the company's profit or loss after deducting all expenses from the revenue. Once we talk about these statements, profit and loss, we means here the expenses which are incurred for generating of revenue have importance. Similarly, other expenses which are also part of these financial statement, cash flow statements. It provided detailed pictures of a company's cash inflows and outflows over a period of time. It helps investor and creditor understand how such cash a company generated from its operation. Investing activities and financing activities means by way of investing activities, by way of financing activities, by way of operation activities. What about the status of the cash inflow as well as outflow? So when we talk about the operating activities for the purpose of cash flow statement, so operating activities is the first under the cash flow statement have a major role. These sections reflect cash generated or used in core operation of the business such as sales, purchase, and operating expenses. Similarly, other activities are also related with the business which is the most important, having the most important place in the business. For example, investing activities. This section focuses on cash flow related to long-term assets such as purchasing or selling property, plant and equipment, or investing in other companies. Similarly, financing activities is also having importance. This section captures cash flow related to funding the businesses such as issuing or repurchasing shares, taking out loans, or repaying debts. So basically, three method of there are three activities through which cash has been generated. First, operating activities. Second, investing activities. Third, financing activities. So basically, these three activities, which is about very close to cash flow statement. Then, statement of stakeholder equity. Now try to understand. The statement of shareholder equity details the change in a company's equity. First, try to understand that the statement of shareholder equities detail the changes in company's equity over a period of time. It helps investors understand how the value of their investment has been affected by the factors such as net income, dividend paid, and share repurchases. It outlines Equity position of the businesses, common stock, retained earning, treasury stock, other comprehensive income. So common stock represent the ownership stake in company held by the shareholder. Retained earning represent accumulated net income that has not been distributed to shareholder as a dividend. When we're talking about the treasury stock, share of companies own stock that have been repurchased and are held by the company. And last, other comprehensive income includes items that affect equity but not included in income such as unrealized gain or losses on investment. When we're talking about the once the books of account is ready, its detailed examination is required. Analyzing financial ratio means financial ratio provide a powerful way to analyze a company's financial performance and position. By comparing different financial metrics, you can gain valuable insight into company's profitability, liquidity, solvency, and efficiency. These ratios are useful for benchmarking performance against industry averages. So under these financial ratios, there are a number of ratios have been classified. First, profitability ratio. It measures a company's ability to generate profit from its operations, such as gross profit margin, operating profit margin, and net profit margin. Similarly, other ratio which is most important, liquidity ratio, assess a company's ability to meet its short-term financial obligations such as current ratio, quick ratio, and cash ratio. If you talk about the current ratio is equal to current assets upon current liabilities. The ideal, the standard for this ratio is 2 is to 1, means 2 current assets, 1 current liabilities. Similarly, the third ratio, financial ratio, which is what solvency ratio, gauge a company's ability to meet its long-term financial obligations, such as debt to equity ratio, times interest earned ratio, and debt to assets ratio. And lastly, we talk about the efficiency ratio, measure how efficiently a company uses its assets, such as inventory, turnover ratio, account receivable, turnover ratio, and assets turnover ratio. So basically, these all are the various types of ratio. So financial ratios means by comparing different financial metrics, you can gain valuable insight into the company's profitability, liquidity, solvency, and efficiency. So these ratios are useful for benchmarking performance against the industry averages. Similarly, interpreting financial data, when we talk about once the books of account is ready, when once the analysis is done, now the most important task is start the reporting and interpreting financial data. Interpreting financial data goes beyond simply calculating ratio. It requires understanding the context and the industry in which the company operates. You need to consider factors such as economic conditions, competition, and industry trends. By looking beyond the numbers, you can gain a deeper understanding of a company performance. And these, the first and most important is the what trend analysis. Analyzing how financial data has changed over time over time can reveal patterns and potential future trends. Similarly, benchmarking, comparing a company's performance to its industry, peer or competitor can provide valuable insight into its relative strengths and weaknesses. And last is the qualitative factors. Consider factors such as management, quality, competitive landscape, and regulatory environments can provide a more complete picture of a company's financial health. So, this is what the financial data, preparing financial statement is not an easy task, as well as its interpretation too. Its analysis too is not also is a very important part. So based on this, once the financial statement are ready, for the purpose of decision making, this accounting information used, and this training required lot of attention. And under this, a number of tools and techniques are available. So there is a lot that we have discussed. And based on these financial statement, budgeting and forecasting. What is budgeting and what is forecasting? Budgeting and forecasting are essential for any business, regardless of size or industry. If you talk about the small business, if you talk about the big business, every business needs, every business require strong budgeting and forecasting. Based on the present trend, they are forecasting for the future. They provide a framework for financial planning and decision making. A budget outlines expected revenue and expenses, while a forecast predicts future financial performance. The first and most important step involved in budgeting and forecasting, the first one is planning and strategy. Budgeting and forecasting start with a clear understanding of company's goals and strategic directions. They provide a roadmap of achieving those goals. Similarly, when we talk about the data analysis, once planning and strategy is done, the second step is data analysis. Accurate data is crucial for effective budgeting and forecasting. These include historical financial data, market trends, and industry projections. Based on the market trend, based on the historical data, industry projections are decided. So, scenario analysis, at the top we talked about our previous lecture, developing multiple scenarios for potential outcomes such as optimistic, pessimistic, and most likely help businesses prepare for the different possibilities. And the last point in budgeting and forecasting, monitoring and adjustment. Regular monitoring and adjustment of budgets and forecasts are essential to ensure that they are remain relevant and accurate. So basically, when we talk about the financial statement analysis, budgeting and forecasting, there are four steps involved. First step, planning and strategy. Second step, data analysis. Third step, scenario analysis. And last, monitoring and adjustment. Furthermore, this financial statement is based on certain rules and regulations. Means you have to follow the certain compliances of the authority as well as regulations. Financial reporting is subject to a range of regulation and compliance requirements. Companies are required to adhere to a specific accounting standard and disclose financial information in a transparent and accurate manner. You can't you can't prepare books of account as per your will and wish. You have to prepare this financial statement as in accordance with the law. Failure to comply can result in penalties and legal consequences. What about the standard has laid down and disclosure the financial information in a transparent and accurate manner? What about the various accounting standard laid down? You have to follow it for preparing financial statement, for preparing books of account. So out of them, few has been mentioned. The first point is the generally accepted accounting principles, GAAP is a set of accounting standards that are used in the United States to ensure consistent financial reporting. Means year by year you are supposed to use only GAAP. Same practices and policies to be followed varies over to year. Similarly, other financial standards are also there, which is known as the International Financial Reporting Standard (IFRS). Is a set of accounting standards that are used in many countries outside the United States. In India, we have in India the concept of IFRS has been adopted. Similarly, other compliance and regulation was mentioned. Securities and Exchange Commission (SEC). It is a what regulatory body that oversees publicly traded companies in the United States, requiring them to file certain financial reports. And the last, compliance and regulation, internal controls. Companies should establish strong internal control to ensure the accuracy and reliability of their financial reporting and mitigate the risk of fraud. So, these all are the various points which you to keep in mind while preparing the financial statements, compliance and regulation. Now, try to understand the balance sheet, assets, liabilities, equity. A company resources including cash, account, receivable, inventory, property, plant and equipment, all of the what? The part of the assets. Similarly, liability includes obligation outside parties such as account payable, salary payable, long-term debts. Equity includes stake in company representing the difference between assets and liabilities. When we're talking about analyzing the income statement, we mean revenue, cost of goods sold, operating expenses, net incomes, the total amount of money earned from the sale of goods or services is known as the revenue. The direct cost associated with producing or acquiring the goods or services sold is known as the cost of goods. Operating expenses incurred running the business, such as salaries, rent, utilities, overhead expenses, advertising expenses. So these are the various operating expenses. Similarly, net income. Once you got the list of the items of indirect expenses as well as the items of indirect incomes, by way of these adjustment you will get either net profit or net loss. The bottom line representing the profit or loss for the set period. When we talk about the evaluation of the income statements, so we mean here on the basis of these operating activities, cash generated or used from day-to-day operation of the business. For example, working capital, which is required day to day for the purpose of smooth functioning of the business. Other activities through which cash has been generated, investing activities, cash used for investment in long-term assets such as property, plant, and equipment. There are a number of activities which is not related to finance, cash repaid from debt, equity, or other financial sources. As we have just right now discussed, the ratio analysis, liquidity, solvency, and profitability measure a company's ability to meet its short-term obligations. Liquidity ratio impact is that it should be meet its short-term obligation. Similarly, solvency ratio talk about assess a company's ability to meet its long-term obligations. And last, profitability, it show the earning capacity of the firm, generate profit from its operation. Trend analysis and benchmarking based on the present and future performance. Based on present, you are going to forecast the futures. Based on the past, present has been decided, and based on present, future has been decided. So this trend analysis continues to talk about the growth, the flow, the patterns, examining a company's financial performance over a period to identify patterns and trends, and similarly benchmarking, comparing a finance comparing a company's performance to industry peers or competitor to assess its relative strength and weaknesses. As I told you that financial statement is the most important the document statement on which entire decision of any company is based. If there is lackness of the finance, if there any kinds of lackness or unutilization of the resources, so it is about red flag and warning signals. If assets is more, liabilities is more compared to assets, is a red signal, warning signal for the business enterprises. First, identifying the red flags and warning signal. Under these, the first one is what? Declining profitability. Means falling margin and reduced profitability can indicate problems with efficiency of competition. Continuously through financial statement, businessman can understand that if there is declining profitability over a year, right? Year to year, it means you have to take the necessary decision, necessary actions, take the corrective action against such kinds of shortfalls. So it is what red flag and warning signals, and similarly rising debt levels is a matter of the very is a matter of the serious discussion. High debt levels, high debt can strain cash flow and increase financial risk. Means it leads to bankruptcy of a company. Why? Continuously debts are rising. The level of debt continuously rising. Profitability simultaneously also lowering down. So you need to take the corrective measures, identify the reason, find out, make a detailed investigation. Similarly, the third point talking about identifying the red flags and warning, inventory building. Excessive inventory levels can indicate weak demands or poor inventory management. Excessive inventory level, because once you have excess inventory level, the capital is blocked. You Once the capital will be free up, you can go for the investment, you go for new projects, you can go for different plant and machinery. But inventory build up, you should to maintain the balance level of inventory which is required. Excessive inventory levels leads can indicate weak demand or poor inventory management. And last point, we were talking about account receivable issue. Slow paying customer can negatively impact cash flow and profitability. You have to take into account the account receivables, similarly account payable. Slow paying customer can negatively impact cash inflow and profitability. If continuously you are incurring debts, is a matter of the serious discussion. That if customer are not paying once the sale has been taken place, it will impact your cash inflow, and ultimately it will lead profitability. Now these are the points you must to address while preparing the books of accounts. Means these financial statement will enable you, it is going to identify red flags and warning signals. You have to find out the causes of declining profitability, rising debt levels, and inventory buildup and account receivable issue. Apart of these, there are also many areas you wish you need to identify. For example, if you talk about the expenses, if we are incurring, if the businesses are incurring continuously various operating as well as non-operating expenses, fixed expenses, irrespective of any kinds of incomes. So it is a what? Red warning, a warning signal, a red flag for the company if they are not going to take the precautionary measures. So ultimately, one day the company is going to be wind up. It will be bankrupt because what? Because of what? You are unable to control your business. So in these red, these are the point which is what red flag and warning signal for the companies. You need to address properly. Based on the present data, we are going to forecast for futures. Forecasting and projections. What do you mean by forecasting and projections? Predict future financial performance based on the historical data and based on current trends. So, current trends reflecting that firms are continuously getting profit. It means that based on this current trend, we can predict, we can forecast for the future that in the upcoming years we will having such $1 billion, such a billion, such a dollars revenue. So, who's on which basis you are going to predict future? Based on this financial, based on the historical data. Talk about the sales, talk about these uh, indirect incomes, right? So, predicting future financial performance can be taken on the basis of the historical financial data. And last, projection, developing hypothetical scenario to explore different potential outcomes. Means you always assume that a hypothetical scenario to explore the possible outcomes, to explore the untouched areas. So this is all about talking about forecasting and the projections. And most important thing, integrating financial and non-financial data. It means once the books of account are ready, once the financial statements are ready, its thorough analysis has been done. Based on this, based on this analysis, a report will be prepared, which is going to tell outside people, outside world about the position, about the financial affair of the company. When we're talking about this integrating financial and non-financial data, so by integrating financial and non-financial data, you gain a more holistic understanding of a company's performance. These approaches consider factors such as customer satisfaction, employee engagement, environmental impact, and brand reputation, providing a well-rounded perspective. So this is what you have to integrate the financial as well as non-financial data, right? So the stakeholder can understand what about the customer satisfaction of a company, what about the level of engagement of the company, what about the what the companies have done for the sustainability environment, and what about the you have the brand goodwill, just like Apple, just like Reliance, and providing a well-round perspective. So you have to integrate both financial as well as non-financial data. What about the company have done for the welfare of the employees? What about the company have done for the mental health, well-being of the employees? Because employees, your employees are doing your businesses, right? Artificial people are just, it is a machine. Artificial intelligence is a machine which you have integrated. But ultimately, the success and failure of business organization is depend on the human beings. So you have to develop such a holistic approach. You have to make a sustainable development. Means company performance should not be just to uh, the company performance not to be measured in terms of financial, but also look for non-financial data. Means what about the company's role towards the environment, building a customer reputations, building a brand. What about the level of engagement? So these all are the points you should keep in mind while integrating financial as well as non-financial data. So based on this lecture, financial and non-financial data is the most important thing, right? So financial statement analysis, just we have discussed right now. Financial statement analysis, in a nutshell, you can say it is the statement of finance, right? Once it is ready, critical examination is required for the purpose of sound decision making, for the purpose of smooth running of the business. Understanding financial statement is fundamental for any business professional, from investor to managers. The ability to interpret and analyze financial data is crucial for informed decision making. This presentation has provided a comprehensive overview of the key financial statements, the components, and how to effectively analyze them. So, in the lecture, what we have discussed, what we have talked about, the financial statement analysis, there are a number of tools and techniques are available for the purpose of decision making, for the purpose of you know financial statement analysis, as we have talked about the profitability ratio, liquidity ratio, solvency ratio, and we have also talked about these liquid solvency ratio. We have also talked about the trend analysis. We talk about sensitivity analysis. We have to also talk about the scenario analysis. So these all are the various ratios from investor to manager. The ability to interpret and analyze financial data is crucial for informed decisions. Decisions are always taken in finance based on certain fact and figure, never in action. So the first point we take the key takeaways. Financial statements are a powerful tool for understanding a company's performance and position. They provide a clear and concise picture of a company's financial health, performance, and position. So, financial statement by way of income, by way of balance sheet, by way of cash flow, these all are the three statements provide the financial health of the business, the financial position of the business, the soundness of the business in terms of liquidity, solvency. What about the position of a company? How much how much solvent, how much liquid you have to pay the external debts. So uh, this statement answered all kinds of questions, right? Similarly, analyzing financial ratios can provide valuable insight into company's profitability, liquidity, solvency, and efficiency. These ratios are useful for benchmarking performance against industry averages and identifying areas for improvements. So, based on this fact and figure, finance based on this fact and figure, so these companies are taking into account. These ratios are helpful for the decision making purposes. Talk about the current ratio, talk about the liquid ratio, talk about the solvency ratio, talk about the profitability ratio, under the profitability, gross profit ratios. These ratios are always taken into account for the decision making purpose. Companies, stakeholders can compare the past, present, and based on this past and present, they are going to predict the futures. So these is also have a very vital role for the decision making purposes. And the third point, compliance with regulation is crucial for accurate and reliable financial reporting. You businessman cannot businesses cannot prepare their books of account as per their wish and will. Companies must adhere to a specific accounting standard and disclose financial information in a transparent and accurate manner. Means as per the Indian accounting standard, as per the GAP, as per the IFRS, we have to prepare your books of accounts. You cannot go, you cannot prepare books of account as per your way. If you going to violate the rules and regulation of accounting, whatever the accountancy for, like fixed assets, like depreciation or for cash flow, you cannot violate. And similarly, you have to also and ensure that it is reliable, it is based on rules and regulation. Because what you are going to prepare a report, company need to adhere to a specific accounting standard, AS1, AS2, AS3, and financial statement in a much more transparent and accurate manner. It is not as per your will and wish. It is as per the books of account, the financial statement as per the Indian accounting standard, as per the generally accepted accounting principles, as per the international financial reporting system. Based on these fundamental doctrines, you need to prepare your books of accounts. So, overall, in a nutshell, we can say that the financial statement are a powerful tool for understanding a company performance and position. So, this is what a uh, small lecture on this financial statement analysis. So, if you have any kinds of doubt, questions, confusion, will feel free to contact us. Any kinds of doubts, any kinds of questions, any kinds of query, we will handle very, positive. We always welcome the suggestions. We always welcome the questions from the student side, from the audience side, from those who are just right now watching this video. Uh, any kinds of questions, doubt, you may please feel to contact at 7618057190. You can contact to me on this number for your any kinds of questions, for any kinds of doubt, for any kinds of query. So, if you have, always love to answer all kinds of queries, all kinds of doubts, confusion, whatsoever the case is. So, last but not least, the last point is a special thanks to the student stakeholder, those who are right now watching this video, for your a special thanks. I would like to express from the deep of my heart a gratitude, a special thanks for watching this video, for your time, patience, for listening, for bearing us. If you facing any kinds of difficulty to understand any kinds of concept, anything else which you are not yet understood, so you may contact to us at any time. So thank you so much for your valuable time, for your patience. Once again, thank you so much. Have a good day.